Okay. All right. So if you haven't already noticed, the midterms are here at the front, so come and get them. They are sorted by last name. All right. So from A through to S, T to Z, in the following row. All right. So come and get them. And before I start, Dave Byrne from PASS just wants to talk to you guys.
Hello. How's everybody doing? Super, I hope. I just wanted to do kind of a midterm reminder about the PASS program. You guys did your midterm on financial accounting, so now we're moving on to kind of a new course like you saw last week. We're doing management accounting. So just a reminder, for those of you that are thinking about attending PASS, feel free to come any week. It's not like you had to come since week 1. So just a reminder where the workshops are on the board here, Monday, Wednesday, 11:30 to 1. That information's on the front page of WebCT. So yeah, come on out, and just a reminder.
All right. So you do have your midterms back, and I will spend some time going through it. A lot of you noticed that it was posted, I think it was Monday night by the time I got to it. So what you can do under your view of things here, go to My Grades. All right. There are 2 columns or rows. I'm not quite sure what your view looks like. Okay. So this is your WebCT. Let me just make that a bit bigger. All right. So the long answer questions, of course, we mark those separately over the weekend. So you're going to see a mark there for the long answer question portion. Then there was the multiple choice questions. Those you answered by Scantron. I'm still amazed at the number of people who didn't fill out their name and number on those. We must have gone back to at least 10. Anyway, to enter that information in. So your multiple choice questions, that was just a separate upload because it comes to me via spreadsheet. So then what this line will do, or column, like I said, I'm not quite sure what yours looks like, is it adds both of them together to get a mark out of 100. All right, so there you go. Some of you were concerned about your mark. The thing I want to say at this point is that there's still 70% of the marks available to get yet. Okay, so I consider that the See Now marks are fairly easy to get. A lot of you, last night I'm looking at the numbers as they're coming in, 100%, no problem whatsoever. So, and then you still have the final exam. So again, the key here, doing lots and lots of practice, right? So that's how we succeed in accounting. I also did post under my course slides here, the PowerPoint, the marking key. Okay, so we're going to go through it today, but there we go. The midterm marking key is posted, all right? So you can take a look at where did you get your marks, okay? And where might you have missed a few, right? So this is what the document looks like. So we can go through some of these questions. I'm going to borrow somebody's here because I don't have the actual one. First question, what financial statement reports the way that net income and the distribution of dividends affect the financial position of the company? I could probably do this. Ooh. Thank you, Charles. I think Charles is up there. All right. So just think about the financial statements you're introduced in the first few chapters. Where do you see one that says dividends? Where do you see one that says net income? That would be the statement of retained earnings, so C. Okay, so that's where that comes from. The second question, how are the income statement and statement of retained earnings related? Again, we spent a lot of time on this. We actually built up all the financial statements. So what do we have here? The net income on the income statement is added to the beginning retained earnings balance on the statement of retained earnings. That's actually correct. So 2 is A. All right, so they are related, and we spent a lot of time looking at that relationship. The third question, there we go. In January, Fenmore Stores pays $1,500 for advertising for the April issue of Restless Style. Okay, that's a magazine. All right. When should Fenmore Stores recognize the advertising expense? I'll never ask you to actually regurgitate the definition of the matching principle, but this is how to apply the matching principle. And so what the matching principle says is when to match our expenses to the revenue in the same period that the revenue is earned. Okay. So they're not going to earn any revenue from this expense until April, until the April issue of Restless Style goes out. So they should be recording it in April. Okay. So that the answer is B. Number 4, in February 2010, Jabot Cosmetics signs a contract to sell lipstick, okay, receives $2,000. It's the full amount, the purchase price of the lipstick at that time. So not unusual to either get a deposit in advance or to actually get the whole contract amount. The lipstick is delivered to the customer evenly over the months of August and September. All right, so when do they recognize the revenue? This is the revenue recognition principle. I'll never ask you for a definition. Okay, I know a lot of people were asking that last week, but I will ask you to actually apply something like the revenue recognition principle, right, to see if did you actually understand it. So the revenue recognition principle says there's a few tests, okay, that we have to satisfy in order before we record revenue, and one is you have to deliver the goods. Right? So receiving the amount or being reasonably assured of collection, knowing the amount and delivering the good or the service. So that doesn't happen till the months of August and September. So they have to do it, you know, I did say evenly. Okay, so we're going to take 1,000 in August and 1,000 in September. There we go. Total liabilities increased by $5,000. You've spent a lot of time working on the effect of a transaction on the accounting equation. So this says if liabilities go up by $5,000, then what else must happen? Okay. So obviously assets can't decrease by $5,000. We need the accounting equation to go up by the same amount. Okay, each side must go up by the same amount. So that's not going to be right. Shareholders' equity must have decreased by $5,000 or assets increased by $5,000. Well, that sounds more like it. Like we want to keep the accounting equation in balance. So B is the right answer there. C, if the retained earnings account increases from the beginning of the year to the end of the year, and go back to that statement of retained earnings. What's happening there? You add in net income, subtract dividends. Okay, so if the balance is going to go up, net income has to be greater than dividends. So A is the answer there. 7, if a business offers invoice terms, 115 and 20. Okay, we did spend some time on this as well. We actually applied these discount terms and what happens with the customer. So basically what this says is you're going to get a 1% discount if you pay in 15 days. Okay? Otherwise, the full amount is due in 20 days. So that's D. We want to match that up. 8. Just talking about interpreting accounts receivable turnover. Okay, so this is how quickly does a company collect its accounts receivable. Williams Investigation has an accounts receivable turnover of 6. Clear Springs is 7. Who collects, or what statement is true? So I'd say Williams doesn't collect as nearly as fast as Clear Springs because theirs is higher. So I'd say A. Clear Springs collects its accounts receivable faster. So we've calculated these numbers, but what does it mean? There was a chapter where we did all these calculations. Baldwin Legal Services. Okay, received $2,000 cash for legal services to be rendered in the future. Whenever that happened, Michael Baldwin recorded it in the unearned service revenue account. If the legal services have been provided at the end of accounting period and no adjusting entry is made, so we have to think one thing after the other. They don't make the adjustment, then what's going to happen? Now, what hasn't happened is that they haven't recognized the revenue. Okay, so therefore, revenues would be understated. All right? So a little bit trickier there. So that's D. Carlton Company, sales of $6,000. We've got returns, discounts, allowances. What's their net sales? I know we did spend quite a lot of time on this. There was a whole chapter where we talked about that. So $6,000, less the returns, less the discounts, less the allowances. No, I don't have a calculator. I don't want to. 10A. It's $5,390 at the end of the day. What is an outstanding check? Okay. There was chapter 5 is on bank rec. Okay, and we did talk about that format, and you did do a bank rec in C now. We did one in class as well, and there was a spot for outstanding checks. What is that? And it's a check that's been written but hasn't cleared the bank account yet because the person you wrote it to hasn't cashed it yet. So it's D. Okay, so 11D. Julianne's bank statement. There we go. All right. Shows that she's got a balance of $245 at December 31st. She's written checks for $34, but these haven't cleared her bank account yet. There's the definition of an outstanding check. Okay, so that's something the bank doesn't know about. As well, the bank informed her that one of the checks she deposited to her account on December the 10th, and the amount of $14 was returned due to NSF. The bank would have already deducted that from the bank balance. We know, obviously they know about it. What is her reconciled or adjusted bank balance? It's 245 less the 34. What is that? 211? 12D. Next up, what is a current asset? Okay, I'd never actually ask you to write it down as a definition, but it's normally those assets that are turned into cash or used up normally within 1 year. Actually, I think this goes straight to the past mock midterm. There was a spot where, like, put in your own words what these definitions are, and there you go. Okay, so, 14, Crimson Lights. It was organized January 1st. It reported the following information for the first 2 years of operations. Right. So, what is the balance of retained earnings? We just have to remember, how do we calculate retained earnings? Okay? So it's, you know, beginning balance plus net income less dividends for a particular year to get ending balance. But I'm asking you, what's retained earnings 2 years later? So they start January 1st, 2008. Retained earnings actually has a balance of 0 at that point. So what you're going to do is add the net income for 2008, 36, less the dividends, 15. And then you're going to add net income for 2009, less the dividends for 2009. So I'm getting 46. I'm getting A. Total assets you didn't need. At the end of the year, before the accounts are adjusted, at Restless Style magazine, accounts receivable has a balance of 200,000. Allowance for doubtful accounts has a negative balance of 2,500. And we've dealt with this before. When I say negative, it's a contra asset account. Okay, therefore it's going to be shown as a subtraction. Okay, an amount that we're going to subtract from the accounts receivable balance. If the estimate of uncollectible accounts determined by aging of the receivable is $8,500, what's the amount of the bad debt expense? Okay, so in this case, we need to know what is the current balance. It's $2,500. It should be $8,500, and we're certainly not there yet. So we'd have to record a bad debt expense of $6,000 in order to get the balance to negative $8,500. Okay, so it would be B. Very similar question for 16, except they take it a little bit differently. Okay, they use percentage of sales method to record the bad debts expense. Here it doesn't matter what the balance in allowance for doubtful accounts is. All you have to do is take the percent. Okay, sales for the year, 1,250,000. Barb Mathena, the collections analyst, feels that 1% of sales are typically uncollectible. Multiply those two together. Okay, you're going to get 12,500. 16 is B. There we go again, Barb Mathena. A credit analyst at Restless Style has just heard that one of the magazine's customers has wound up operations due to bankruptcy. Unsecured creditors like Restless Style will not be receiving any amounts, fortunately, and they owe $1,000, this customer. How should she record this write-off? I know we certainly took up problems like this in class, and there might have even been one on CNOW. Okay, so we're going to remove it from accounts receivable. We don't want to show this anymore on there. But the other part of it, we're going to remove it using allowance for doubtful accounts. So 17 will be D. Tucker McCall bought a special piece of equipment. Invoice cost of $1,000. Modifies it. He transports it. He insures it. He's going to have an overhaul eventually. How much should he record this asset on the balance sheet as? Well, the overhaul, we're not going to include. The insurance costs for the first year, certainly not. Okay, so what we will include is the transportation and the modification costs. Okay, so it would be $1,293, so that would be A. Oh, I like this one. Gloria Bardwell bought Glowworm Lounge from Neil Winters for $775,000. Right, so those of you who watch Young and the Restless, you'll have an added advantage here of actually knowing something about Glowworm Lounge. The net identifiable assets of the lounge had a market value of $540, creating goodwill on the books of Glowworm of $235. Simply the difference. Gloria would like to expense goodwill over 20 years. What is the annual amortization? Okay, so Gloria even admitted it in Young and the Restless. She goes, I know nothing about accounting. She called her son in. All right, so he could take a look at the books. Of course, now he's involved with money laundering. But anyway, so it's actually 0. We don't expense amortization. All right, so she does know nothing about accounting. All right, it is 0. Anyway, I would trust her husband. Does anybody trust Gloria Bardwell's husband on Young and the Restless? Anyway, I remember a time. Gloria Bardwell's husband is an actor who used to play on this old television show. Back in the olden days, there was a show called Dallas. Anyway, he was the younger Ewing brother. Anyway, that was another century. Jabot Cosmetics issues 10-year bonds. Face value of $10 million. Stated rate of interest is 8%. Market rate of interest is 5%. Basically, I'm asking you, are they going to sell at a premium discount or at par? Or maybe they should even hire Abby Newman for public relations work. Okay. No, they shouldn't, okay, by the way. D is not, no, definitely not right. So, you know, they're going to have an easy time of selling these bonds if they've set a stated rate of 8%, market rate is 5%. People are going to be lined up out the door to buy these things, okay? But Jabot says, you know, is thinking, well, I'm not going to pay 8% when I can just pay 5%, okay? They'll be able to sell it at a premium. Because everybody's going to want it. All right, so Newman Enterprises declares a 4-for-1 stock split. I think this is very similar to one of your See Now quizzes. I think it was a 2-for-1 stock split, though. So if everything stays the same, what technically should happen to the market price? This should be divided into 4. Okay, so the answer is C. Daniel Romalotti Photography. That's 22. Issues a $5,000 60-day 12% note to the bank. What's the amount due at maturity? Remember that formula that we saw in class, the principal times the annual interest rate, and these are always annual interest rates that we're giving you, times the time period that you need to accrue for. So if I do that $5,000 times the 12%, and I only want 60 days of the year, so I can do 2 things here. I can put 60 over 365 or 2 months over 12. Doesn't matter, you're going to get the same answer. Okay, so you're going to have to round up if you use days, but anyway, so it's about $100. So the amount that he'll owe at maturity is $5,100, so 22 is C. Lastly, current assets of Leonard Company. Okay, so I'm digressing, I realize, from Young and the Restless. Okay, Leonard is a character on another one of my favorite TV shows, The Big Bang Theory. Anyway, so Leonard has current assets of $550,000, okay, and $533,000 on the previous year. By what percentage did current assets increase? Okay, so they went from $533 to $550. So that's a difference of $17,000. I have to put it over the old year. Okay, all right, so I'm getting 3.1 or 3.2. Anyway, I'm going to have to round up to the nearest tenth decimal place here. I forgot to do that, so it'll be 3.2. And that was multiple choice, very quickly. All right, I can't show you the rest of this person's midterm, but we'll go through. I'm sure you've all got one in front of you anyway. Oh yeah, so they're each worth 2.5 marks. Okay, and so those went into WebCT separately as its own column. Long answer question. So you've got a whole lot of inventory transactions. All right. They use the periodic inventory system. Right. So this is a large inventory of DNA tests that Chancellor Industries has because paternity is such a recurring theme on Young and the Restless. What is the merchandise inventory account as it should be recorded on the balance sheet at the end of the year using first in, first out inventory cost flow assumption? Okay. So what does that mean, first in, first out? The first cost in, so the costs you see at the beginning of the table are the first ones that are going to be assigned to cost of goods sold. What's going to remain at the end of the year are the most recent purchases. Right? So the first step would be actually to calculate how many units do I have on hand. Okay. So we know how many we have to cost. We started with 20, we bought 60, sold 65, bought 50, sold 32, bought 30, 26. You should have gotten 37 units there. Okay. So there, that's what I've done. And we'll use the most recent purchases. All right. So start at the units at $555. Okay. And then we need 7 more in order to make 37. So we'll take 7 at $540. Now I realized that it was a bit ambiguous. When I said 555, a lot of people thought that that was in total, and that was fine. So I came up with an alternative solution. So 30 units could have cost you 555 in total. And then you'd have to figure out what was the per unit cost here on those 7 units that we bought. So I get $75.60. So the other right answer, 2 right answers, $630.60. Right. The next one Oh yeah, lots of part marks too. If I saw anything, I'd give part marks. The next question, calculate the cost of merchandise sold using the weighted average method. Right, so you need to come up with one average now for the entire year. Right, so we have to take the cost of the beginning inventory plus all of the purchases. And so I've extended it here, assuming you did it based on that $500 was unit cost. I get the total beginning inventory plus all purchases here equal to $86,560. Right? Then you divide by the number of units that were ever available. So that would be the 20 in the beginning inventory plus all the purchases here, okay, to get the 160. So the weighted average cost per unit is $541. And you have to figure out the number of units that were sold during the year. That's 123. Trying to make this bigger. All right, and so all we have to do is just multiply through 123 units times the 541. However, I realize that some of you might have thought that the beginning inventory was $500 in total. So if you did that, you should have got an average cost of $13.40. Okay. And then the cost of merchandise sold would have been $1,648. Next up, a whole lot of transactions. And what I was looking for was the transactions at the end of December. Okay, and I realized I didn't mark this question, one of the TAs did, but he kept coming to me saying, they've done the original entry. So anyway, there was no marks for putting in what the original entry might have been. I was only looking for entries at the end of December. Okay, so July the 1st, they buy the insurance premium. They increase the prepaid insurance account at that time. What's the adjusting entry December 31st? Okay, so half of it has expired. So $600 has expired. So they have to reduce the prepaid insurance account, and we expense that. So retained earnings will be going down. Next up, it's not so much an adjusting entry, but just how to record a repair. Okay, so Bert's Garage completed a repair on one of the trucks at $600. They haven't yet recorded it. So this is something they owe Bert's Garage. So accounts payable will go up. That's what's missing, a negative there. Anyway, that's not showing up too well. Oh, I see. Anyway. That's why it's not showing up very well. So that should be negative 800 on the other side. So it's repairs expense. Okay. Tax bill has come in. They haven't paid it yet. Okay, so you could increase your accounts payable, and it's income tax expense, which has the effect of reducing retained earnings. Next up, they sell merchandise that hasn't been recorded. Again, not so much as an adjusting entry, but how do you record the sale of merchandise? That's what I'm asking for here. So it was on account. They'll pay it within 30 days. So we'll have to record two parts of the transaction. The first one here is sales. Accounts receivable will go up. Sales will have the effect of increasing retained earnings. And then we'll record the fact that our merchandise inventory has been sold. So the cost of goods sold, the cost of the merchandise sold over here. E, the company bought supplies at the beginning of the year for $1,000. They do a count at the end of the year. There's $400 on hand. So they've used up $600. Again, a lot of people showed the original transaction. I was just looking for what will actually happen on December the 31st, which is that supplies on hand will decrease by $600 retained earnings. That's supplies expense. Okay. Wages earned but not yet paid. Okay, so wages payable will go up by $1,500. And the wages expense, reducing retained earnings. Income tax expense payable on the 2010 net income, $8,000. So we can record that as accounts payable. Some of you created an income tax payable, that's fine. And the income tax expense reduces retained earnings. Okay. Next up, Victor Newman buys a van. Okay. Abby Newman borrows it the following year, and it's a write-off. She gets into an accident. So first off, what was the depreciation for 2010 using two methods? All right, so there's a formula for calculating straight line depreciation, original cost less the salvage value divided by the number of years of useful life. But they bought it on April the 1st, so you've got to take a partial year there. Okay, so 1 mark for calculating straight line, 1 mark for calculating the fact that, it's just 9/12 of the year. Okay. Double declining balance method. First of all, figure out the rate. It's 25%. You get 2 marks for that. Multiply it by the original cost, but again, there's only 9/12 of the year. Okay, so. And then what is the effect on the accounts of the insurance settlement? So there's two things that have to be done. Bring the insurance up to date and then show the effect of the insurance proceeds. Okay, so accumulated depreciation, oh, and they have settled on straight line. Okay. Accumulated depreciation, we know the annual rate, but they only had it for 4 months of the year before Abby totaled the van. Okay, so so there we go. And then retained earnings, that's depreciation expense. Okay. Then the proceeds of disposition, the insurance proceeds here, $10,000. We're going to take the vehicle off of the account. So at that point, the accumulated depreciation on the vehicles has got a balance of $37.92. We'll remove that. And this is a loss on disposal of $16,208. Okay. And you know, if you put anything in there, like I'm looking at the exam here in front of me, you know, just by putting in cash, you didn't have to have the whole thing here. That was worth half a mark. You know, certain things we gave part marks wherever possible. Last one was on ratios. You did have the ratio sheet. I did post the ratio sheet on WebCT before the exam. I mentioned it many times. So I'm sort of giving you a heads up as to which ones might have been included, right? So, you know, at the very least, I would have expected you to understand what ratios you were looking at, you know, on that sheet, okay? So I asked for the current ratio of Sheldon Cooper's Theoretical Physics Lab Limited, again, from Big Bang Theory. Gosh, I like that show. It's really well written. Anyway, so Sheldon Cooper's lab is got a lot of liquidity. Okay, so you take the current assets divided by the current liabilities. It can cover current liabilities many times over. Okay, and it's just a matter of going into the financial statements and just picking them up. Okay, I mean they're even clearly marked here. I'm not going to show you this part, but you know, current assets 93,000, current liabilities 12,000. Just pick it and put it into the formula. Accounts receivable turnover. What we're looking there for is sales divided by the average accounts receivable balance. Okay, sales 762. Although I marked this question, a lot of people picked gross profit for some reason. They picked the 352. Okay, we were looking for sales. So, oh, thank you. The average accounts receivable balance, you've got to take the average of both the 40 and the 27 up here. Okay, so add them up and divide by 2. Right? Times interest earned. All right, so we have to go to the income statement for that. So basically, you want income before income tax and interest. Right? So we'll start, you know, you can start here at the bottom, 140, and work your way up. We'll add back the 60. We'll add back the interest of 5. Or you could have started here, income before income taxes is 200, and then just add back interest expense of 5. Okay, so a lot of people put cost of goods sold in there. I don't know why. They put total operating expenses in there, and again, I don't know why. It is interest expense, right, of $5,000. Right, so that's how we calculate that. So Sheldon can cover his interest expense many times over, 41 times. Liabilities to shareholders' equity, that's exactly as you would think. Liabilities on the top, to shareholders' equity on the bottom. Now this one did require a calculation. Okay, so total liabilities, I don't have a line for that. So when we go to the balance sheet, you have to add the current liabilities to the long-term note. Shareholders' equity, again, didn't have a line, but, you know, figured out 7 plus the 64 is 71. Right, so put the two together, and I get 1.01. So that was the midterm. So check it online that this marking key is there. Any questions, come see me after class, during my office hours. Okay, and certainly I can review any one of these questions with you. Okay. There we go. Where am I now? Oh no. Great. Somehow lost my slides for today. All right. Go find them. And we'll continue on with managerial accounting today. Chapter 11. I don't know why that didn't appear. Okay, so this is a completely different sort of course is what I normally call it. Because I normally teach this into 2 sections. I spend one course on financial accounting. We've already covered that. It's certainly not all the topics I would normally cover. It's certainly not in as much depth. Now we're into managerial accounting. It's a completely different course. Okay, so yeah, we've talked a little bit about accounts and how they work in the last class, and that'll be pretty much it, okay, in terms of the effect of transactions on accounts. Okay? From now on, we're going to be looking at how can accounting information help managers make decisions, help business owners make decisions. Right? And what is absolutely critical to that is to know how do costs behave. Right? So, you know, if you're asked for a budget, cost behavior will certainly help you. Okay? Just knowing, well, what's going to go up if I make more units, or what cost will stay the same if I make more units or less units. Okay? So that's one aspect of this chapter. The other aspect of this chapter is cost volume profit analysis, meaning how much money do I have to have in sales in order to break even? Or how many units do I have to sell in order to break even? Or how much sales do I need in order to have a net income of whatever, operating income of $10,000 this month? Right? And this is absolutely critical for managers to understand. Right? So what are we going to do? We'll classify costs, okay, whether they be variable, fixed, okay, or something called mixed, okay, which is a little bit of variable and a little bit of fixed. Right? And we're going to introduce even more vocabulary. Okay. I know this whole course is heavy on vocabulary, but this is one we're going to see often. Contribution margin. Right? You're going to see this often. It's going to come and haunt you in many chapters. Okay, so not just this one, but there's a chapter coming up on decision making. You're going to see it there. All right. What other chapter are we going to see where you're going to see this? So we're going to see it in decision making. We're going to see it in budgeting, right? And even in performance evaluation. So that's something to keep in mind. And then that's cost behavior. And then we're going to be talking about break-even point and target profit. Okay? So a lot of companies, they constantly monitor their sales. Okay? Oh, I had sales of whatever today. I grew up, my dad had stores growing up, retail stores, wholesale companies. And every day, you know, the topic around the conversation at the supper table, what were my daily sales, okay? Because it was a family business, right? So, you know, my sisters were working in the store, my mother was working in the store, everybody worked in the store. And number one, well, we had sales of so much, okay? And then my father could easily tell from that sales amount how much his profit would be for the day, okay? Or did he break even today, right? And that's exactly what we're going to focus on, is what amount of sales will it take in order to achieve the break-even point, or what amount of sales do we need in order to achieve a target profit? We're not going to spend a lot of time on the charting. All right? I do have it in here, but I'm going to let a YouTube video take care of that, so we're going to disregard all the slides I actually put in there. And I'm certainly going to talk about operating leverage and margin of safety. I'm going to remove, I'm not going to be covering the companies that sell more than one product. Okay, so I am taking out more out of these chapters as the term goes on. All right, so that's our roadmap for today. Okay, so cost behavior. And doesn't this seem so simple, right? Costs can either be variable, fixed, or a little bit of both, and we call that mixed, right? So what does it mean to be variable? It means usually it's based on the number of units that you're producing. So the more units that you make, okay, the more variable costs in total you're going to have, because a variable cost will be incurred every time you make a unit, generally. That's the activity base that we look at. Or a cost could be fixed. Okay, so over wide ranges of activity, you know, the salary of the controller remains the same. Okay, or over wide ranges of activity, the property taxes are going to be the same. Okay, so that's fixed. And then we have some that are a little bit of both, a little bit of fixed and a little bit of variable. Right? So right now, you know, hydro costs, they're a little bit of variable, right? Because we see, okay, there's you know, usage charges based on kilowatt hours, but then there's like debt retirement charges, and there's all sorts of these other charges that seem to be fixed. Anyway, I don't know exactly how they're calculated. Or it might be maintenance costs in total. You know, they're a little bit fixed. You might be paying a salary to a maintenance supervisor or maintenance technician, and then there might be a variable component. Right? The more units that you make, or the more activity you have in the factory, the more maintenance supplies you'll need. Right? So Maintenance might be considered a mixed cost that way. It's going to have a fixed component and a variable component. So two factors to consider. One of them is the activity base. Okay? What is causing that cost to be incurred? Right? So generally, throughout this chapter anyway, we're going to consider the number of units produced being the main activity base. Okay? But also, you know, there's some other quite good activity bases: direct labor hours, machine hours, units sold, kilometers driven, number of square feet of the factory, number of text messages, whatever. Right? But by and large, we'll be looking at units produced here. Okay? So the other factor to consider is relevant range. Right? So you've got, you know, a wide range of activity where our assumptions about costs are going to hold true. Right? So we're going to need, let's say, one maintenance technician. Showing up? Okay. So let's say we need one maintenance technician to service our factory right now, and we make, you know, 10,000 widgets every year. And that's based on, I don't know, we've got 5 machines going, and the maintenance technician, you know, services all of these machines. Okay? And, you know, we hum along at 10,000 widgets every year for many years. Okay? Maybe sometimes it's 9,000, maybe sometimes it's 11,000, but still that maintenance technician can maintain all of those machines. Okay? Maybe sometimes it slips to 8,000, it goes up as high as 12,000. Again, that maintenance technician can, you know, maintain all of the machines. But let's say we increase the amount of widgets we make to 20,000 widgets every year. Okay. Then we're going to need to get another maintenance technician. Okay. So the fixed cost of that maintenance technician, I don't know, let's say we give him $50,000 a year. That fixed cost is going to hold true over, you know, a certain range of activity. Let's say from 9,000 to 12,000 widgets. Okay. But as soon as we get, you know, more activity going, we've got 20,000 widgets that we're going to make, we're going to have to hire another technician. Our fixed costs are going to increase. Okay? But at this range, fixed costs are $50,000. Okay? So from 9,000 to 12,000 widgets, or 8,000 to 12,000 widgets, we can make do with one maintenance technician. Okay? And that would be what we call the relevant range for that fixed cost. It's going to hold true for that. The textbook defines it as period of interest, but really what it is, you know, what do we know about our cost assumptions holding true at a certain range? All right, so here's an example of some variable cost. Direct material is actually a variable cost. So, you know, we talked last week about the lemonade stand, right? So every time you make a glass of lemonade, you're going to incur a direct material charge. A cost for the sugar, a cost for the lemons. You know, maybe you're buying some fancy spring water to go with that. Right? So, you know, maybe, you know, in total it's $1 per pitcher of lemonade that you're going to incur. So every time you make a pitcher of lemonade, you incur that charge. Right? So, you know, the more units here that you make, and this is what this chart is showing. You know, we start at 5,000 units. Our direct material charge is 50,000. The more units we make, the greater in total this becomes. Because direct material costs, we're going to state them on a per unit basis. Okay? So $10 in this example per unit. Right? And again, that's over the relevant range. Right? So you might be getting, you know, a certain price from 5,000 units to 30,000 units, but after that you might get a break. Right? You might get a volume discount, and so this might actually even go down. But at this relevant range, from 5 to 30,000 units, the direct material cost per unit holds true. Okay, it's $10. But it could be that once you get, let's say, to 40, you get a volume discount. All right? So that's why we refer to this as the relevant range, because this cost assumption is holding true, this $10 cost per unit. Okay? So direct materials, certainly a variable cost, a true variable cost. Going back to last week and all the new cost terms that we were introduced to, what's another cost that we might consider variable? It's incurred only whenever you make one of your units or provide that service. Another cost that is variable. Okay, so direct materials was one of the cost terms. What was another one of the cost terms we can consider here?
Indirect materials.
What?
Indirect materials.
Indirect materials? Now, that would be like the cost of the maintenance supplies on the machine. Okay? And certainly, you know, that could be something that is variable, because the more units you're going to make, the more times your machine is going to not need some maintenance. Okay? And so indirect materials can certainly be a variable cost. Okay? It'll go up in total the more units that you make. It's another cost that would probably go up in total the more units that you make.
Labor.
Labor, right, direct labor. Okay, so in my Julianne's lemonade example, she hires her sister to make the lemonade. Okay, so she's only going to pay her if she's going to be making lemonade. So we have to assume something about direct labor there. So for every, let's say for every pitcher of lemonade, she gives her sister $1. So there we go. So it's $1 per unit. The more pitchers of lemonade that are made, the greater the total direct labor cost. So what are some variable costs? Direct materials, certainly. We see it here. Direct labor. Indirect materials. Now we also saw some other type of costs, period costs. Okay, and some period costs can also be variable. What period costs? Those are the ones we expense right away. What sort of period costs would be considered variable, would act as a variable cost? Let's go back. There are two kinds of period costs. Anybody remember which ones they are? Okay. Selling and admin. Okay, so think of those. What are those costs? The cost of marketing your product, the cost of your sales commissions, the cost of shipping, okay, and admin costs, the cost of raising the invoice, of preparing the invoice and mailing it out. Of all those costs, which ones are variable costs? Commissions, right? So for every unit made and sold, you give $1 to your sales rep. Okay. There's some more variable selling and admin costs out there too. Shipping. Okay. More units you sell, the more your shipping costs are. You know, it's $5 per box. It doesn't ship out, you know, to your client, your customer. Okay. So there are some examples then of variable costs. Oh, there we go. Yeah, right. Okay, we can graph it. And that looks all kind of grade A. So what's on the x-axis down here? The number of units produced. Okay, and then the direct material cost in total. Okay, so dollars here, the number here. So the more units that you make of model JS12 here, the greater the variable cost. We see it sloping up. Up it goes. All right. And then if we wanted to graph the unit cost, unit variable cost, it would remain the same. It's always at $10. Okay. Fixed costs don't behave that way. They're going to remain the same over wide ranges of activity. Okay, so here is a salary for Jane Savisi, right? And her salary is going to remain the same. It doesn't matter how many bottles of perfume that you've got here that you're going to make. And what we could do, you know, and this happens often, is we could take her salary and divide it by the number of bottles, right? So, you know, if they only sell 50,000 bottles of perfume, the salary per bottle is $1,500. Okay? But if they make 300,000 bottles, it's only 25 cents. 25 cents. No, that would be. This is wrong. It's $250. Anyway, I'll just scan this in from the textbook, and it's wrong. Anyway, so over wide ranges of activity, salaries stay the same. Okay, so if you've got, you know, a salary included in one of your manufacturing costs and one of your selling and admin costs, it would be considered a fixed cost. And it could be a salary of anybody. Okay, it could be the the manufacturing supervisor, it could be the plant manager, it could be the security guard, could be the maintenance technician. Doesn't matter how many units or bottles of perfume in this case that they make, salaries will stay the same. You're not going to say, oh, we're going to make more perfume, I'm going to give you more of the salary. It's not that's not always how salaries work. I give them a bonus, but anyway, if you're doing a good job. What other costs that we saw last week act on a fixed basis, act fixed? We saw quite a lot of costs last week. We've already determined that direct labor, direct material are variable. There's that whole category of overhead. What overhead cost acts on a fixed basis? It's going to stay the same. Fixed costs. Got some there. The salary of the supervisor, the salary of the plant manager. What other overhead items are fixed? Rent, right. Doesn't matter if you make 1 unit, 10,000 units, your rent is going to stay the same. What else? There's going to be more. You might have to pay property taxes. Is this all coming back to you now? All right. Property taxes, going to stay the same. Might go up next year, mind you, but it will stay the same over wide ranges of activity. The city is not going to come back and reassess your property if you make 300,000 bottles of perfume this year instead of 50. Okay? Stays the same. What else will stay the same over wide ranges of activity? Depreciation, right. And we talked about depreciation on all the factory equipment. Okay. And if you do straight line, that remains the same. There's another method that we didn't cover, but it could be variable, but I don't even have to talk about that in this class. Quite happy. What else remains the same over wide ranges of activity? Now, not necessarily overhead, but consider selling and admin, those period costs. What's a fixed selling and admin cost?
Cost of goods sold.
That's not a selling and admin cost, first of all. Cost of goods sold in a manufacturing environment is, well, just to that, your manufacturing costs. Your overheads, your selling and admin, operating expenses. Call it that. All right. President's salary. I don't know, the cost of the accounting system, I don't know, the salary of the accountant. Depreciation on the office equipment. Advertising campaigns, I'm thinking more now selling. The cost of advertising. Doesn't matter if you sell more or less, that advertising is fixed. You hope to sell more. Might not happen. All right, so over wide ranges of activity, there we go, costs remain the same. But if we were to calculate the unit cost, it would actually go down as the level of activity increases. And we can graph it, there we go. Number of units produced here on the X, dollars here of the supervisor's salary on the Y. Okay, remains the same over wide ranges of activity. But if we were to graph the unit cost, it would actually go down. The more units we make, less per unit. All right. Then we got something called mixed costs. It's a little bit of both. And you know, maintenance is one of those. You've got a maintenance technician, you offer him a salary or her a salary, and then you've got some supplies which, you know, as you make more widgets, you're going to incur more supplies, that indirect materials. Right? So there's a fixed and a variable component there to the maintenance department. Right? And if we were to graph it, we'd actually see a fixed portion. It will not go below $15,000, and then a variable portion. So we add, you know, a variable portion here to it. Right? So sometimes it's handy just to be able to calculate the fixed and the variable portion so that if we're given, the number of widgets that we're making, okay, we're making 9,000 widgets, we can easily predict the total maintenance cost. Or if you're given 12,000 widgets, what's the total maintenance cost I should expect? Okay, if we can just somehow put that into a formula, right, with a fixed component and a variable cost component to it. Okay. It will help with budgeting, okay, and it will certainly help for the rest of this chapter, predicting things like what is our break-even point? What about target sales for the target profit? Okay. And how can we do that? We've got a variable portion, salary. Okay. Then we've got a fixed portion, example, a salary, and we've got a variable portion, example, supplies for the maintenance department. Okay. How can we predict this? Well, by using a formula. Okay. And so my formula here, I'm going to call it y equals a plus bx. So a is the fixed cost, because it's always going to be the same. B is the variable portion, but I'm going to multiply it by x. Okay, the number of units here that I'm making, the level of activity. Okay. So I'm trying to separate it out so I can easily predict the cost of the maintenance department. Now, I'm going to ask you to go back a few years of your life here, and sometime in grade 9 or sometime in grade 10, you might have seen a formula that looked very similar to this. Does anybody remember what it was? It was y plus mx plus b. Anybody remember what that was for? Slope of, well, it's the formula for a straight line. Right? Does anybody remember that? Go way back. I know it was a long time ago. Grade 9 or 10. My daughter promises me, I've got one of my kids is in grade 12, and she promises me, yes, Mom, I've seen this before. It was in grade 9 or grade 10, and it's the formula for a straight line. Okay? And that is what a mixed cost is. We graphed it already on a previous slide. Okay? Except you would have called it mx plus b. I do believe that's the way the Ontario curriculum calls it anyway. We're going to do the same thing. Okay? And I'm taking a look at this, and I'm trying to remember, well, what portion was the slope? It was here. Okay, B. Right. So yes, variable cost per unit is the slope of the line. Okay, and how do you calculate the slope? Does anybody remember that? Go way back. What's the numerator for the slope? Starts with the number. Yeah, so the rise over the run. Do they still talk in those terms, or? Yeah? Okay. That's how they talked about it in the olden days. Okay. So there we go. The change in y and the change in x, the rise over the run. Okay. So the change in the total cost. Okay. Here's your rise over your run. Okay. Then that's the first step. Let's calculate the slope. Okay. So the change in y over the change in x, so the rise over the run. And the way I'm graphing, I've got the number of units on the x, I've got dollars on the y. Okay. So y is the rise, and that's the change in the total cost. And x is my activity level. Okay. So what I have to do, though, is I have to find the highest point and the lowest point in terms of activity. Okay. I'm going to take the slope. Let's go back. I know, it's been a long time, since you've seen this. I'm going to take the activity at the highest point and the lowest point, because I want to get the best fit of a line. Okay, I can measure the slope anywhere in between, but my data isn't acting linearly necessarily. Okay, if you were to plot it, it would be like all over the place. Sometimes it'd be here, and I just want the best fit of a line. Okay, so I'm just going to plot a line, and I'm going to measure the rise over the run from the highest point and the lowest point, and that's why we call it the high-low method. Okay. Right, so I'm going to go find the highest level activity and the lowest level of activity, and I'm going to take a look at, well, what's the change in the cost there, and what's the change in the dollars? So let's get some real data here. We've got better cheddar, they make some cheese, okay? And they want to plan the overhead costs, and they know that overhead is a mixed cost. It's got a bit of variable and a bit of fixed. Okay? So they take a look at their overhead costs at various monthly production numbers here in this column. Okay? So in January, they make 1,000 kilograms of cheese. Overhead is 12,000. Okay? And activity is all over the place. Okay? And again, if I was to graph this, it'd be all over the place too. It doesn't necessarily behave linearly, but we're going to try to make it fit, because I want to be able to predict this. I need to know what my variable costs are, what my fixed costs are. Okay? So the first step is that I need to find the highest activity level. Where are you? There. And I need to find the lowest activity level. So, I think I've got it circled. It's 1,000, right? Lowest. All right. So again, if I was to plot this would be the top of the line and the lowest part of the line. Okay. So I've got my data variable and fixed overhead in total, $12,000 at 1,000 kilograms of cheese. And overhead is all over the place. First step, what's the highest activity level? What's the lowest activity level? I'm going to take the top of the slope of the line, the bottom of the line. All right, so January is the slowest month. That's the low. May is the busiest month. So first step, I want to calculate the slope of the line. So we do the rise over the run, or the change in total cost over the change in activity. Okay, I use delta for change. Do they still do that? Does somebody do that still in math somewhere? I was thinking maybe it was my teacher from a long time ago. So D for delta, or difference. Okay. So the change in the dollar value, okay, from the highest point to the lowest point, 16,500 to 12,000. I'm just getting that from the previous slide. 16,500 and 12,000. The change in the dollars. Yeah? There is?
10,000.
Oh, see. The point, though, is we have to look at the production numbers, not the dollars. Okay, so you've actually noticed something. That this isn't behaving linearly, is it? You'd expect that at 12,150, that this should actually be more than 12,000, right? So notice that, well, this isn't behaving as it should. And he's right. And that's why we look at the production numbers. Okay, we have to look here at the number of kilograms that are produced for the high and the low. Right? So not take a look at that one. So we're going to look at the change in the dollars, the 16,500 and the 12,000. That's my rise, my run. The change in the dollars, 2,125 and 1,000. Okay, so on the bottom, 2,125 and 1,000. So from this, I'm going to get the variable portion, $4 a kilogram. Right? So $4,500 divided by 1,125 kilograms of cheese, that's $4 a kilogram. It's going to help me go a long way to be able to calculate my overhead costs here. I've got the variable portion. The next step is to substitute it back in to either the high point or the low point. Okay? So we go back to that formula, y equals a plus bx. And at the lowest point, okay, my total overhead, my y, was $12,000. So I substitute that back in. Total cost, $12,000. Remember, A is my fixed portion. Okay? And I haven't solved for that yet, and I'd like to, so I'm going to keep it as A. All right? And I'm going to substitute, I know my B now, it's 4, and I'm going to put the 1,000 kilograms of cheese right, in there. So that I can isolate, well, what's the variable portion in total? In this case, it's $4,000, the 4 times 1,000. So when I solve for A, I get $8,000. That's the fixed portion. Okay, that line will never go below $8,000. It'll always be $8,000. So fixed cost is $8,000. Variable cost, $4 per kilogram of cheese. Is it all coming back to you now? Slope of a line, rise over run, right? We've graphed it. You recall how you graph things in grade 9 and 10? And this can help us budget for overhead in this case and do some analysis. We need to know how much of our costs are fixed, how much of our costs are variable, so we can do things like break-even analysis So we can do things like target profit. Very important to be able to break it apart. There is another way of doing this, by the way. Those of you who've taken stats, what's the other method? Anybody taken stats? I know I don't have just first years here. To try to make data fit a formula in the best possible way. Best fit, yeah? Or least squares regression. Yeah, so you can do that too. And then you'd be much more precise than me, okay? So least squares regression attempts to put the best fit of a line so that the averages, I think, between the data points and the line are the least amount, all right? Has anybody taken this, is it in stats or algebra? I forget what course it is. Sure, some of you have, and you're looking at me like, high-low is not very accurate, okay? And you're right. Least squares regression is best fit, yeah?
Solve for A, is X always the lowest level I
You can put it into the highest point or the lowest point. I think that's a good question. I substituted it back into the low point, okay? But back in high or low, okay? Because we're saying that those are going to be on the line, okay? And that all the other data points are not. So if you substituted it into any other point, you're not going to get the correct fixed cost, according to the high-low method. Okay. So yeah, it's not perfect, okay, but it's good enough. Okay. In management accounting, it's accuracy, yes, is important, but we're not going to go to the ends of the earth to get the most accurate fixed portion, the most accurate variable portion. If we're out by 1/10 of a penny, that's okay. You know? So yes, I realize there are better methods. Okay, so we're going to do an example based on this high-low method concept. Right, so Blowing Rock Railroad decided to use the high-low method in operating data from the past 6 months to estimate the fixed and variable components of transportation costs. The activity base used by Blowing Rock Railroad is a measure of railroad operating activity termed gross ton miles. Who knew? Which is the total number of tons multiplied by the miles moved. Oh, interesting. So we're given a table of data, very similar to the cheese example. We're given total transportation costs, and gross ton miles. And they're saying that's a good predictor, a good activity measure of transportation costs. And at the end here, we're asked, determine the variable cost per gross ton mile and the fixed cost. So first step, we have to find the high and the low point. And it's not in dollars, okay? And that's something that's actually quite important. We're not going to be looking at this dollar column, transportation costs. We're going to be looking at the gross ton miles. We have to look at the high-low in terms of the activity level. Okay? So highest number, I don't know, I got 310, no, 325. And the lowest number, I think it's 200. There we go. Okay, so it's highest and lowest point in terms of activity, okay, not dollars. So, first step, we're going to calculate the variable portion, or B in my case, and rise over run if you're a scientist or an engineer. But for the rest of us, we remember that as the change in dollars over the change in the activity level. So the change in dollars, these are the data points I'm interested in. 875, 600. Change in activity level, so that's the number of gross ton miles. So there's the variable portion. I get 220 per gross ton mile. Right, so we've answered the first question, the variable cost per gross ton mile. second part of the question, they want to know what's the fixed cost. Okay, well, I'm going to need that. And I'm going to substitute it back into my formula. This was B that I solved for. All right. So Y is the total cost, and I'm going to substitute it back into either the low data point or the high. Okay. Flip a coin. In these problems, what's interesting is you'll always get the same answer, so it doesn't matter which one I substitute it back into. I think I'll do March. So total dollars, the transportation cost there was 600,000, and that was when the activity level was 200,000 miles. There we go. So there's the fixed portion is 160,000. So it looks like transportation costs will never go below 160,000. That's the fixed portion. Any questions on that? Is it all coming back to you? All of this stuff you thought there was never use for, grade 9 and 10 math. Yeah, I thought that too. Let's see. Okay. So what we're going to be focusing in on now is cost, volume, profit analysis. So it's, how are sales, volume, and profits and expenses all related? Okay? And that can help us do things such as selling prices, selecting the optimal product mix, marketing strategies. Should we spend more on advertising? Analyzing the effects of cost changes on profit. What if we bought, this piece of equipment and our depreciation costs went up? Okay, how will that change our profit? So we'll bring it all together, and we're going to introduce this concept of contribution margin. You're going to see this often in this half of the course. And it's quite simple. And you think, well, that can't cause me too much grief, but we can do a lot with this. Contribution margin is simply sales less variable costs. Sounds great. This is what it looks like. Sales can be expressed on a total basis or even a per unit basis. Okay, so in total, I sold 2,000 units at $50 a unit. That's $100,000. Okay, I can express it total. I can express it on a per unit basis. My variable cost, well, if I sold 2,000 units, my variable costs are $30 a unit at 60. That's my 30. So my contribution margin, simply sales less variable costs, $40,000. I can express contribution margin a number of ways. In total, 40,000. Per unit, it's 20. I can even do something called a contribution margin ratio. So what is that? It is what is the contribution margin expressed as a percentage of sales. And it doesn't matter if you would have done the unit, 20 divided by 50, or 40,000 divided by 100,000, you're still going to get 40%. Okay. This is a new way, actually, we're going to start structuring our income statement. It's going to look like this. All variable costs, we're going to lump them together. Okay. And when I talk about variable costs here, in calculating contribution margin, I mean all variable costs. So, what's included under this variable cost? We had some examples earlier. All direct labor. All direct materials. Somebody said indirect materials can act variably. Okay. Sales commissions. Even your variable selling and admin goes here. What else did we say here? Shipping. All variable costs, all variable manufacturing costs, all variable selling and admin costs, all going to be lumped in together. And this is why we had to split out our variable portion earlier. Okay? It's going to be the basis of a lot of analysis. Right? And just knowing what your variable costs are, which costs are going to be incurred if I sell another unit, okay? If I make another batch of lemonade, okay? If I make another calculator, what are my increased costs going to be? Okay? Quite helpful. Right. And so this concept of contribution margin leads us into a discussion of a contribution format income statement. Okay? So instead of our typical income statement looking like sales less cost of goods sold equals gross profit less operating costs, we're going to structure our costs according to their behavior. Variable costs, okay, and fixed costs all lumped together. So we see our calculation of contribution margin, right? Sales revenue less all variable costs. Okay? And then from that, we're going to subtract out fixed costs, so whatever they are. In this case, let's say they're $30,000. So that leads us to an operating income of $10,000. Where did they get the word contribution margin? It contributes to fixed costs. Okay? And that's what format is really emphasizing. How much of our total revenue here, how much of our contribution margin do we have left over in order to cover our fixed costs? It's as simple as that. It's unfortunate, though, you don't see accounting systems set up like this to actually prepare an income statement by cost behavior, lumping the variable costs and the fixed costs together. Okay? You see cost of goods sold, think of all the income statements you've seen so far. You see operating costs. And that's not too useful, okay, when it comes to analysis. Right? But it's certainly something that I do, okay, especially at the Horticultural Council. What's fixed? What's variable? And actually, most of our costs are fixed. But anyway, it really helps in order to understand, our budgeting process. Right. So we can use contribution margin ratio. It's quite handy in order to predict increases in operating income. Okay. So we have an $80,000 increase in sales. That would increase contribution margin by 40% of that. Okay? Just remember, sales less variable costs equals contribution margin. And what this contribution margin is saying is, what is the contribution margin we're going to get based on a percentage of sales? So if we multiply through, that's $32,000. Okay? So sales go up by $80,000. Multiplied by a contribution ratio, we know exactly now how much our contribution margin will go up by, $32,000. How will that affect operating income? Well, we know that fixed costs stay fixed, right? We've seen that. We've graphed it, done a lot of things with fixed costs, but it will stay fixed. That means operating income goes up by $32,000. So really easy to see what an increase in sales will do to your bottom line. Okay? Sales go up by $80,000. What's going to be the net effect on the operating income? $32,000. Okay, so rather handy to know this about your business. Okay. So let's say our sales increase. They go from $10,000 to $12,000. What's now going to happen to our operating income? Okay. Well, we can do it the long way, the before and the after. Right. So before, we were selling 2,000 units, okay? And if we multiply 2,000 times 50, we're at 100. Variable costs are 30. Okay? I'm using the same data over and over again, by the way. 2,000 less 30 is 60. So we were at 40,000. It goes back a number of slides. I'm keeping all that before data the same. But let's say we sell 10,000 more units. What's going to happen? Okay, sales will go to 600,000. Variable costs will go to 360. Contribution margin go to $240,000. I could have done the calculation that way, or I could have done it the quick and easy way. And that would just be sales increased by 10,000 units. My unit contribution margin, I know to be $20. Therefore, my contribution margin will go up by $200,000. Okay. What would happen to operating income if we keep going? How much will operating income increase by? Fixed costs remain the same, right? So it goes up by $200,000 as well. Really handy to know your unit contribution margin and your contribution margin ratio. Now, what is the break-even point? Yeah, so the revenues and costs are the same. Okay. And that is useful in business planning, especially when increasing or decreasing operations. Sounds great. But what point in the business life cycle do you think this would be the most appropriate? Why would you want to calculate break-even point? At what point in a business's life? The middle of its life? Beginning of its life? The end of its life? When are you most going to be interested in this? Break-even. beginning. Yeah. You want to, businesses, whenever they first start, you know, they're just hoping to break even. And where do I have it? I pull up, I was reading The Citizen yesterday. Okay, so this is the business section of the Ottawa Citizen. I have to cite this, and I'm only going to use part of it. All right, so Wednesday, November the 3rd, 2010, this is the business section, and there we go. There's a picture of 3 Carleton grads. Right, so you guys are going to graduate one day. And they are producing an iPad app to help doctors with their bedside manner. Anyway, so it says, I'll just read part of it. A major part of the Ottawa Hospital's plan to modernize its information technology system is in the hands of 3 former Carleton University students who graduated only 18 months ago. The 3, founders of Select Start Studios, have been commissioned by the hospital to develop applications for iPads that will enable doctors to markedly improve their bedside treatment. Currently being tested, the system will enable doctors to soon have bedside access to detailed information on patients and lab results. An iPhone version is also in the works. Mention that. We work closely with the hospital to turn what is typically a consumer product into a solution for the hospital staff and patients, said Adam McNamara, 25, a co-founder. The goal is to improve the doctor-patient experience while allowing the hospital to operate more efficiently. While working with hospital staff, McNamara and the other co-founders, Tariq Zaid, 29, and Joshua Tessier, 24, realized the extent of the opportunities to apply mobile software to patient care. Electronic health records are just the beginning, said Zaid. We have an incredible opportunity to bring functions like explaining an MRI or ordering a prescription to the bedside. So they call themselves Select Start Studios. Brand new company in Ottawa, founded by 3 Carleton grads. Right? The 3 started the company before they even graduated, having worked on iPhone games in their spare time toward the end of their computer science studies. Those of you in computer science, pay attention. It wasn't long before they were ramping up business. Right? So they developed mobile apps for customers. All right, so there we go. You've got a business just at the beginning, and they are, I'm sure, keenly interested in what's their break-even point. All right? This is generally where we see break-even point applied. It's at the beginning of a company's existence. My brother-in-law is opening up a restaurant this month, not in Ottawa, somewhere in southwestern Ontario, and this is of utmost importance to him. He wants to know what levels of revenues does he need in order to break even. Okay. So very much of interest to the beginning company. So there's an quick and easy way of figuring this out, and it's using the contribution margin per unit. Surprise, surprise. So if you're given the selling price per unit, and in our example so far it's been $50, and you know what the variable cost is, and that's all variable costs, from direct labor, direct materials, some overhead is variable, variable selling, commissions, shipping, variable admin, add them all up. What is it on a per cost basis? Okay. You can calculate something called contribution margin per unit, $20. Okay. And in order to quick and easily figure out what's your break-even sales in units, all you have to do is take your fixed costs and divide by the unit contribution margin. Okay. That's simple. So in this case, $30,000 divided by the $20 unit contribution margin will tell me that I have to sell 1,500 of these in order to break even. Right? So it gives you that sales goal. Let's make 1,500 units. Let's sell 1,500 units. Okay. And if you want, I can prove it. Those of you in math, you ever asked for a proof? A few times? Yeah? You know what that is? Okay. I'm going to prove it. I'm going to put actual numbers into it. All right. So here's the proof. If I sell 1,500 units at $50, my sales will be $75,000. Variable costs, that's $30, hasn't changed per unit. In total, that'll be $45,000. So my contribution margin is $30,000. Fixed costs are $30,000. Therefore, I broke even. Operating income is 0. Okay. So there's one formula to remember. I'm going to call it BEP in units. All right, so that's something you're going to remember something from that chapter, remember that. Obviously, just by looking at that formula, we see that there's a direct relationship between fixed cost and break-even point. Okay. See the formula? We can see that. So if we change up fixed costs, which is something we're considering here in this example. Let's say we're considering advertising campaign of $100,000. That's going to change things up. Okay? That won't change my selling price. That'll stay the same. It was 50, now 50. No, it'll stay the same. Okay? Yeah, you just do this. So advertising, let's say, of $100,000, that won't change the variable cost either. That'll stay the same. Unit contribution margin stays the same. However, my fixed costs will change. I'll go from 30 to 130. That's an increase there of 100,000. Okay, how will that change my break-even point? It's going to go from 1,500, just calculated that, to 6,500. How do I know that? I've got another formula there. There we go. My new break-even point, my new fixed costs are 130. Unit contribution margin stayed the same. So that's going to be 6,500. Okay, that's where I get that. That means I'm going to have to sell an extra 5,000 units in order to cover the cost of that advertising campaign. So I'm going to have to ask myself, do I think I'll sell an extra 5,000 units by advertising? By incurring all this advertising cost of $100,000? Right? Really hard to say. But hopefully you've done some research, some focus groups, some market research in order to figure that out, in order to be confident in that. So before you actually sign those advertising contracts, you know. Right. All right, there's also a direct relationship between variable costs, which are included here, and the break-even point. Okay. So as variable costs go up, your break-even point will also have to go up. And we see that here. Let's say we consider a commission, 2% commission. How will that affect break-even sales? Well, it's not going to change my selling price. That's going to be the same here. But my variable cost will go up. Okay, I'm considering a 2% commission. Okay, so that's an extra $1 on every unit I sell and have to give to my sales reps. Okay, so that increases it by $1. It goes from 30 to 31. Right? That's going to reduce my unit contribution margin. I'm going to go down. Right? So what will happen to my break-even point? Well, it's going to go up, surprisingly. And there's the calculation. Fixed costs have remained the same. However, my unit contribution margin has decreased. Therefore, I have to sell more. Okay. To sell an extra 79 units more. So, is it worth it? If I pay my sales reps an extra, 2% commission, will they generate 79 more units in sales? Okay, I really have to look hard at the numbers and ask myself that question, and hopefully I'll come to an educated answer, an informed answer anyway. There's an inverse relationship between break-even point and the selling price. Okay? If you increase your selling price, break-even point will go down. Surprise! We sort of knew that, right? So if we increase our price by $10, it goes from 50 to 60. Variable costs stay the same. Unit contribution margin goes up. Fantastic. What will happen to break-even point? It will go down. My new unit contribution margin is 30. Break-even point is now $1,000. So, but I have to ask myself that. Is it worth a price increase? Will I actually lose more than $500, 500 units in sales? Okay. Very important to know. Another way we can apply all of these variable costs, fixed cost analysis is to calculate sales needed to generate a target profit. Okay. So, we got the Carleton grads there. They've been in business for a while. They're selling their iPad apps. Okay. They're hoping to break even. But, later on in a business's life, they might be looking for a certain profit, okay, where they'll have a profit target. Okay. So do I see anything here on that? I always see one. Anyway. There's always something in the paper about somebody's target profit, or this was more than expected. Yeah, Molson Coors beats forecast. Okay, So Molson Coors Brewing Company reported higher than expected quarterly profit. Okay, so they've got a target profit, right? And that was due to increased prices and cost savings. So sale price went up, contribution margin, maybe they had some cost savings there, so contribution margin, going up. And they actually had declining sales volume. Wow. So they also warned they'll be reducing their inventories. That's it. Net income was $256.1 million US. Wow. Wow. And that topped analyst average estimate of $1.13 per share. Anyway, so as businesses like Molson Coors, continue on in business, they have a certain target profit. And so what they're going to want to know is how many bottles of beer do I need to sell in order to achieve this profit? Okay. My shareholders are expecting a nice, tidy profit. So we're going to change our formula up just a little bit. Okay. Number of units that are needed to attain a target profit. This is what the formula looks like. We're going to take our fixed cost, that stays on the top, but we're going to add the target profit to that. Okay. So whatever it is. So in this case, their target profit is $100,000. And we're going to divide that now by the unit contribution margin. Okay. So we've got this company, fixed costs haven't changed, 30,000. Selling price hasn't changed, variable costs haven't changed. I'm using the same numbers throughout here. However, they want a target profit, $100,000. Okay. So how many units do they have to sell? I'll put it into the formula. 6,500. All right, so there's one other formula to remember. This is in units. And I'll prove it to you. There we go. If they sell 6,500 units, sales will be 325. Contribution margin, 130,000. Fixed costs are 30, leaving them with an operating income of 100,000. Surprise. All right. This might be a good spot for a break. All right. So I've got, just about 10 after 10. All right. So we'll come back at 25 after 10. And we'll do the problem. So we're back. So I'll ask you to bring your conversations to a close, please. All right, so we're back. And so I'll ask you to bring your conversations to a close, please. It's okay to have a conversation just outside of the class now that I'm back, okay? So that the other people can hear. Right, so we're going to continue on with the cost volume analysis, cost volume profit analysis. And so what this problem does is it takes us through a whole lot of questions, right, about what we know so far. And there are two formulas, basically, to memorize here. Okay? So yes, you do have to memorize a few. So Battenkill Company, operating at full capacity, sold 112,800 units at a price of $150 per unit during 2010. Here is their traditional income statement. So it doesn't look like the format that I just introduced you to. That's called the contribution format. This is the traditional income statement. Right? So what else do we know? We know how fixed and variable costs behave. They're going to give us a percentage. Right? So of the cost of goods of merchandise sold, the cost of sales, 40% of that number is fixed, 60% is variable. So here on this slide, the cost of goods sold is split out fixed and variable. And the split is 40% fixed and 60% variable. That's what they're telling us in that table. Okay? Then they also tell us about selling. Okay? What is fixed and what is variable. Right? That's the next line. It's 50-50. I can't write. And admin, its split is 70% fixed and 30% variable. So that's all they're doing. Okay, so that we know what fixed and variable is. Management is considering a plant expansion program that will permit an increase of $1,500,000 in yearly sales. The expansion will increase fixed costs by $200,000, but will not affect the relationship between sales and variable costs. This is exactly like your See Now quiz, except I'm going to warn you this time. I've done something called an algorithmic See Now question. So the numbers are going to change on every attempt, right? Just so you know. So the numbers won't look like this. They're going to change up every time, and it's exactly like this. All right? So when you're asked to determine the total fixed costs for the year, if I go to the See Now quiz, are you still there? There you go. It's the same problem, except it says algorithmic. The numbers have changed. All right? So these numbers here are changing, and they will ask you the same questions. What are the fixed costs? What are the variable costs? What's the unit variable costs? What's the unit contribution margin, etc. Okay, so if you pay attention today, this will come really quickly and easily for you as you do the See Now quiz over the weekend or whenever you do it. Okay, so first step, determine for 2010 the total fixed costs. Well, I think that's something we know a little bit about already. Yeah, it's 1. We just have to do all that multiplying through. Okay, we've got the breakdown. Oh, and it's all gone now. Cost of goods sold. There's a fixed portion. There's a variable portion, right? Selling and admin. Right, again, can be broken down. So the $6 million of cost of goods sold that we've got there, we know that 40% is fixed. And $6 million of the fixed costs, of the cost of goods sold, 60% is variable. So that's $3.6 million there. The selling expenses, it's 50-50. If I go selling, there's $3 million, it's 50-50. So 50% fixed, 50% variable. The admin, they've got 1.8 there, million. And 70% of that is fixed. All right, so 1.8 million. So I think that was it for the expenses. So we'll just tally them up. Right, so we've determined total fixed costs, total variable costs. We've answered question number 1. I want us to continue on with some of these numbers. What's the unit variable cost? Well, I know what the total variable cost was. Well, I could figure out the unit variable cost if I know how many units they made and sold, which I think we know. What is it? There we go. 112,800. So we're going to take total variable costs, divide it by the number of units that they made. Oh, I like it. It's a nice even number, $50. Okay. And the unit contribution margin. How do we calculate contribution margin again? Quick. Okay, some of these you're going to have to commit to memory. That's one of the formulas you're definitely going to have to know. Contribution margin is? Dave.
think it's selling price minus variable cost.
Very good. Yes, selling price minus variable cost. And the selling price we do know. 150. Thank you very much. So, look at that. I can do it without a calculator even. Oh, by the way, a lot of you forgot your calculators at the midterm. I counted at least 10. I know there's a few people suffering in silence. Do not ever forget your calculator at an accounting test, all right? Because the numbers aren't always going to be this easy, honestly. Sometimes it will be a little bit more complicated than that. All right, what else do they ask us? Break-even sales in units. Well, again, these are the formulas that you're just going to have to remember. So I'm going to switch back here. I should actually put in here contribution margin. So here's some more things to memorize. I know, what a drag. And I won't be giving you a little formula sheet for the final exam to show you this. But so you will have to know what contribution margin is. You will have to know the formula for your break-even point. That's what that stands for. And to achieve your target profit. Okay. What number of units will you have to sell? Right? So they are asking us, what is the break-even point in units for 2010? So I know I'm going to need fixed costs, unit contribution margin. Look at that. I've got total fixed costs. I've got unit contribution margin. Just grab the numbers, put them into the formula. So that's the formula we need. We know all these numbers from the previous requirements. Oh, look at that. I might even be able to do this without a calculator too. Up to at the end. There we go. 51,600. Okay. What is the break-even sales under the proposed program? Okay. So we know how things are right now. They look like this. They are considering a proposed program where, what is it? A plant expansion program, there it is. Okay. That will increase fixed costs by 200,000. So what is going to be our new break-even sales in units with this new plan? Well, I know that fixed costs are going to change, right? This is where they are now. This new program is going to increase fixed costs by 200,000. And that's it. The unit contribution margin stays the same. There we go. Okay. Wow, look at that. I'm halfway down the quiz already. Just took minutes. Number 5, determine the amount of sales in units that would be necessary under the proposed program to realize the $6,120,000 of income from operations that was earned in 2010. Sounds like a target profit thing, right? So there's another formula, again, that you're going to need to commit to memory. To achieve some sort of target profit in units, that's what they're asking, this is the formula we're going to need. Okay? So far, 3 formulas from this chapter, so far. So to achieve the target profit, I'm going to use that formula on the previous sheet. Right. And they'd like us to realize $6,120,000 of income here. That would be necessary under the proposed program. Okay, well, I do know that fixed costs have changed. From the last question, I know that it was $5,160,000 plus that extra annual fixed cost. So it's now at $5,360,000. Okay, things changed up a bit in the proposed program. But I still want to make the same amount of money as I did the year before. right, so what do I get? 114,800 units. Okay. So fixed costs have changed under the new program. Right? If we go back to the last requirement, number 4, the last question, they asked for the new break-even point under this new program. The fixed costs have changed. They're now 5,360,000. That's what I'm putting there. But this formula also asks for profit on the numerator side of things. All right, so we have to sell a whole lot more units. The next one's rather interesting. Determine the maximum income from operations possible with the expanded plant. Well, we're going to have to go back to some of this capacity issues, which generally doesn't happen in this book, but anyway. It says that this program will permit an increase of $1,500,000 in yearly sales. Okay, so you're obviously able to make more. Okay? It's an expansion program. Obviously, sounds like you're going to be making more units, sales can increase. And that's what they're speaking to here. What is the maximum income from operations possible? Well, if they sell all those units, what will be the maximum amount of income? Let's go back to their own words here. They said that increase in yearly sales. So sales increase by... And I know that I sell them all for, what was it, $150? That's my selling price. So what is that then? I'm not good with that part. 10,000. Never know all my zeros. They can sell an extra 10,000 units. That's what they're saying. So if I can sell an extra 10,000 units, what's going to happen to my my income from operations? Okay, so actually what I'll do, there's a quick way, but I'll just take it through the long way right now. I'll calculate everything. What will my new sales be? Okay. What do I know about sales? I'm at 16,920,000. It's going to go up by 1.5 million. My variable costs, how will that switch up? Well, I don't think it's changing at all per unit. I know that my variable costs are $50 a unit. Okay. I just have to know how many units am I selling. Well, I can actually figure that out just by this number here. I am probably selling, if I divide by the selling price, 18 million. 122,800 units. Okay. So that's what that sales number translates into. If I just divide by the selling price of $150, okay, I'll get 122,800 units. Okay. So my sales have changed up. My variable costs will change up. I need to know how many units am I selling? So I'm going to just grab that number there. It's 50. 6,140,000. Contribution margin, that's changed. Where are you? 280. And I know my fixed costs have changed as well. Right? This all goes back to the previous questions. I'm just going to pull that in. From number 5, my new fixed cost was 5,360,000. Yep, 6920. All right, just want to make sure my calculator's working. I just double checked everything. All right, so that one's a little bit different, hey? We have to figure out, okay, we're expanding the plant. That's going to give us the ability to sell more units, make more units. So the maximum income from operations with the expanded plant, this is what my new numbers will look like, 6,920,000. If the proposal is accepted and the sales remain at the 2010 level, what will the income or loss from operations be for 2011? Okay, so we're not going to sell 18,420,000, but nor will our variable costs be this, but our fixed costs will stay there. So let's take a look at what will happen. Sales are going to stay the same. Let's go back. What are sales? Will variable costs stay the same? What do you think? If sales stay the same, will variable costs stay the same? Yes, I think so. And we've already calculated that in, where did we calculate? Number 1. We calculated what the variable costs were. Fixed costs, we've calculated that one out before too. So I can take that from number 5. Go. All right, so number 8. Based on the data given, would you recommend accepting the proposal? These are the sorts of things that managers face all the time. Sure, let's expand the plant. Sales could remain the same, or they could, increase by as much as, what did they say? $1.5 million. Okay. So we know that before, right, what's our operating income before? We're given that. 6,120,000. The income afterward, well, if sales stayed the same, that's what we just calculated here. Our operating income could be 5,920,000. Could be even higher. How did we figure it out? If we sold all those extra units, it could be 6,920. 6,920,000. That's a risk, eh? Based on the data given, would you recommend accepting the proposal? Are you absolutely certain that you're going to have more operating income? No. Let's hope you do some market research, okay? Like, is there a market for your extra units that you can produce now? All right. Hopefully you've got some good marketing people, right? Or you can say with some confidence that, sales would increase at least somewhat. So they wouldn't actually go down. That's the most income you'll actually make, but it's a gamble. That's what business is, by the way. It's risk. It's taking that risk. Any questions on that problem? Yes, Jason.
Fixed costs are fixed. You always have no problem. Fixed costs.
Yeah, well, there depends on how the question is worded. So if the proposal is accepted, and with the expanded plant, it means our fixed costs are going up in each of those instances. Okay. So, yeah, so that's why we added the increase there, because they assume that you're going forward with it. So now our fixed costs are 5,360,000. Yeah. Let me see. Yeah, there it is. It's on that slide there. Okay. Any other questions? Because this is exactly like your See Now quiz, except the numbers are going to switch with every take. Okay, it's called algorithmic. It's not going to stay the same every take. Right? So, yeah, it's been nice and easy that way. You know, on every take, the numbers stayed the same. But this time it will be algorithmic. I don't want to talk too much about cost volume profit charts. I know there's a whole lot of slides coming up about that. However, what I did find, this is rather interesting, I found a 1.5-minute YouTube video that speaks to this. So we'll let the video do it. And that was it. That's 1.5 minutes of cost volume profit charts. That's all you really need to know. All right? So yeah, it's just a way of visualizing it. Okay? So line for total revenue, a line for total costs. Below the break-even point, you're losing money. Above, you are making money. All right? And that's what that said. And other than, I don't want to spend a lot of time on this, so I'm just going to fly through these charts. Okay? And I know originally I was thinking of putting in sales mix considerations, but I actually don't want to cover that. There are some topics, though, after this that I do want to cover. Okay, so you're not responsible for sales mix. Let's put it that way. That's where a company sells more than one product. It's actually the way things are. Okay, but we will talk about operating leverage, okay, which I find just fascinating. Anyway, why is it when some companies gain revenue or gain sales that they make so much more money? Okay, their net income goes up by so much more than other companies. Okay, so you might have a company 10% increase in sales, huge increase in the bottom line. Okay, another company 10% increase in sales, not so big an increase in the bottom line. What is it about those companies? And it actually can be explained through this, it's something called degree of operating leverage or just operating leverage. Right? And it speaks to that cost mix. Okay? Your percentage of costs that are variable, your percentage of costs that are fixed. Okay? So companies with high fixed costs have high operating leverage. What does that mean? It means if their sales go up by just 2%, right, their operating income goes up by many times more that. Many, many times. Okay. Company with low fixed costs has something called low operating leverage. A little bit of an increase, sales, little increase in net income. Right? So we use operating leverage to measure how changes in sales affect changes in income from operations. Okay. So high operating leverage, this is what I was trying to explain. 10% increase in sales, many more times that as an increase in operating income. Right? A company with low operating leverage, 10% increase in sales only yields a 20% increase in operating income. So why is this? And how do we calculate that? Right? Oh, there's no, yeah. So we actually calculate operating leverage by just taking the total contribution margin and dividing by income from operations. You're going to get a number. Okay? And that number is going to tell you what percent increase in sale. If you multiply your operating leverage number by the increased percentage in sales, it'll tell you how much your percent increase in operating income will be. Or it can go the other way too. A decrease in sales. What's going to happen to their increase or decrease in net income? All right. So we'll take a look at two companies here, Varner and King Inc. They've got the following data. Right? So quite different cost structures. Right? So if we take a look at Varner, $300,000 in sales, $120,000 in variable costs. Contribution margin is $180,000. What is that? That's 60%. Eh? I'm just curious. And for King, contribution margin ratio, I know it's 40%. And here, they've got a lot more fixed costs than King does. Right? So what we'll first do is calculate the operating leverage. Okay, so this is another one to add to your list of formulas. Contribution margin over operating income or net income. So now we're up to four formulas. You have to remember. And so we're going to need that for this exercise. So for Varner, it's simply taking the total contribution margin, where are you, 180,000, dividing by income from operations, 60. Oh, I can even do this one in my head. It's 3. King. Again, just pulling the numbers off of their income statement and into the formula. We get 240,000 here over 160. $1.5. Okay, so they've got a higher, well, we call it degree of operating leverage than King. Okay, so Varner is more highly leveraged than King. Right? So if income from operations increase for each company by 20%, what's going to happen? Or if sales increases by 20%, what's going to happen to income from operations? That's what the next line is saying. How much would income from operations increase for each company if the sales of each increased by 20%? This is the interesting thing. You take your degree of operating leverage, this is for Varner, and you multiply it by the percentage increase in sales. And this will tell me how much net income will go up by, or operating income. So a 60% increase in operating income. For King, you take that operating leverage number, multiply that by the 20% increase in sales, and it's not going to be as much. Right. So that's how that works, and it's just puts a relationship between the fixed and the variable costs in order to predict what's going to happen to operating income. What you're going to find is if a company is really close to their break-even point, they're going to have a higher degree of operating leverage. Okay? And if a company's got a higher amount of fixed costs, okay, generally as a percentage of total, they're going to have a higher degree of operating leverage as well. So why is there a difference in the increase in income from operations for the two companies? It's cost structures. And again, this is very eerily similar to your See Now quiz. The See Now quiz. I think it's number 2. Number 2? Should be number 2. Yeah. Okay, and it looks awfully similar, right? Except it's algorithmic, so the numbers are going to change on every take. All right, so you know. So it says Varner and King. Wow, we just did a problem that said Varner and King. But my numbers are different here. It's not what my problem looks like. Okay. And how would income from operations increase for each company if the sales increased by 15%? So Looks very similar. So I haven't really given you the answer, but I've given you how to find out the answer. You've got the formula. Multiply through the degree of operating leverage by that increase in sales. Margin of safety, that's kind of like a cushion. Okay, so we're operating at this level. Our break-even point is here. Let's measure the space between those 2 points. Okay, so it measures how much sales revenue can drop before an operating loss occurs. And this is how we measure margin of safety. Our current actual sales, where we are now, and if we subtract that from the sales at the break-even point. Okay. So assume that current sales are $250,000 and the break-even sales are $200,000. The margin of safety is 20%. So actually, margin of safety can be expressed a number of different ways. It can be in units, it can be in dollars, as well as percentage. Break-even point, sales. Okay. So if you wanted to do a percent, you take all of that, divide by the actual sales, all of that. I'm trying to fit all the formulas onto one page. You can see what I'm trying to do. All right, so we'll work on a little problem, a little exercise. Again, very eerily similar to your See Now quiz. Oh, I'm giving everything away today. So, if Sama Company, with a break-even point at $360,000 of sales, write that down, has actual sales of $480,000, what is the margin of safety expressed in dollars and as a percent? Okay. So in dollars, it'll simply be actual sales less the break-even point sales. In percent, actual sales, break-even point sales, all over the actual sales. Okay. So we'll do that. In dollars, what are their actual sales? 480. Break-even point. Oh, it's nice. They even calculated break-even point. There. So that's 120,000. You could also do it in percentage. Yeah, 25%. Okay. Oh, the next one's a bit tricky. Aren't you glad you stayed for the rest of the class? This is exactly how it is on your See Now quiz, remember that. So if the margin of safety for Watkins Company is 25%, okay, so that's similar to this, eh? Same number. Fixed costs were $1.2 million, variable costs were 75% of sales. What was the amount of actual sales dollars? Hint, determine the break-even in sales dollars first. So they say find the break-even point in sales dollars. Well, I know how to do it in units. And I don't have any units. So you're going to formula that was given, right? It's fixed cost divided by the unit contribution margin. I'm going to give you another formula that you might find useful. Break-even point in sales dollars, which I don't think is even covered in the book. Actually, no, it's not covered in the book. So aren't you really glad you stayed? It's fixed cost divided by the contribution margin ratio. How about that? So that's what we're going to use in order to calculate what they're asking for here. And they're telling us, what's the break-even? Calculate, determine the break-even point in sales dollars first. Okay, well, I know what the fixed costs are. Okay, what's my contribution margin ratio? They're giving me my variable sales, my variable costs are 75% of sales. See that? So if I was to take a look at their contribution margin format income statement, I'd see sales here. Variable costs are 75%. My contribution margin, therefore, is 25%. Right? Is this all making sense? We're given what the variable costs are as a percentage of sales. Okay. 75%. This is given. All right. Therefore, my contribution margin ratio must be 25%. Everybody following that? And that's what I need here. What do I get? 4.8 million. And that's what I get there. So if I was to calculate, do as they say, determine the break-even point in sales dollars first, I get 4.8 million. Okay? That's a good hint, actually. Because what they're actually asking for is, what is the amount of actual sales dollars? Well, let's go back to that other formula we know. That was what was been presented, right? We're all good with that? It was on the previous slide. The margin of safety, expressed as a percentage, is actual sales less break-even point divided by actual sales. There we go. It's right there. And they're saying that that whole thing, the margin of safety, is 25%. It's like a word problem. This is 25%. Solve for actual sales. I don't know what actual sales is, but solve for it. What are my break-even point sales? I know that already. I just calculated that. They gave me that nice big hint, and I calculated that first. Okay, so that was just from the last sheet, 4.8 million. Let's solve now for actual sales. Can we do it? Anybody remember this? I know. It's algebra. Wasn't my favorite subject. All right, so what can we do here? I can multiply each side by actual sales. When I do that, I get rid of this thing on the bottom, right? Anybody remember algebra? If I multiply each side by actual sales, I'll actually remove this little thing on the bottom because I don't want it there. There. So what I've done, multiply by actual sales. Okay, so that's what I've done in order to get to this point. I have to do it to each side, right? I can't just multiply actual sales to one side. I have to do it to both sides. So in this case, I get 25% times actual sales. And on this side, I remove what's on the bottom. It cancels it out. Okay, so now this makes it a little bit easier. I'm going to move that over. And I'm going to subtract 25% there. Everybody still with me? Anybody take this sort of algebra before in high school? Yeah? Good. All right, so then what are actual sales? 6.4 million. All right, yeah, it's a little bit more algebra and it's like a word problem, which I never did like. But after you've done a few of them, it gets a little bit easier. And that's the end of chapter 11, thank goodness. All right, so good luck on the See Now quiz. I've given you all the problems, except they're going to be algorithmic, right? So they will switch up with every take. Right, good luck.